Good morning, everybody. Welcome back to the Opportunistic Trader. It is just after 11, and we are joined by Commodity Research Group's Andy Lebow to discuss the latest DOE inventory report and talk energy. How's it going today, Andy?
It's going great, Michael.
So I hear it's a bit cold up north. Is that
Oh
why
man,
energy prices are higher, or what's going
yeah, it
on?
could be. It's probably not as cold as it is in Chicago here in New
I know, that
York,
looks
but
crazy.
it's still. I think we're getting this tomorrow.
So
Lucky
take us
day.
through the numbers. What did it look like? We got crude trading at the high of the year, basically, within a few pennies. We're 54.59, up 2.5%.
Well, I thought the numbers were bullish. They were constructive. We had a rise in crude, but less than what we expected. The market was looking for an increase of 3.1. It came in at zero point 0.9. So I guess that was bullish. But the real bullish numbers were on the products, which finally are showing a little signs of life. Gasoline drew somehow by 2.2 million. The market had been looking for expectations or for a build of 2.7, and distillates drew as well, down 1.1 versus expects of 1.2. And total inventories were down 4.8. So I thought, again, on balance, pretty bullish, and just looking at some of the highlights that I'm sure traders are focusing on. One was on U.S. domestic production, which was unchanged at 11.9 million barrels a day, which continues to be, that's a record. Now, Michael, there is something to focus on U.S. production, that we're probably going to have what's known as freeze outs in North Dakota because of this cold weather. So I would expect that U.S. production over the next few weeks is going to decline. I don't know by how much, but that's somewhat seasonal. But I'm sure we'll see production down, and maybe the market takes that as bullish. Certainly not bearish. The other highlight on gasoline or crude runs came off hard in the Midwest and in the Gulf Coast. We'll see if this cold weather has any impact on the Chicago area, on the Midwestern and particularly the Chicago area refineries. The big BP Whiting refineries has had some problems last week, so we'll see if that's an issue. So that's something that I'm sure the market again is focused on, no doubt. And last week, stocks finally drew. They're still too high on gasoline. Gasoline is a big problem globally, but at least we saw a draw here. In terms of days supply, gasoline's at 28.8 versus the 4-year average of 28.5. So it's around normal, but at 257.4, that's too high. And on distillates, a stock draw. We're at 34.8 days versus 39.5, the 4-year average. We're in pretty good, we're in okay shape on distillates. Of course, distillate stocks have built by over 20 million barrels since December 19th. And total inventories were down by 5 million. Total inventories have built 30 million since December 19th, but at 1.2 billion. There's 60 days supply versus the 4-year average of 62.7. So again, I think this report was certainly constructive.
Yeah, well, that's what the market's telling us also. At this point, are you more bullish where's the opportunity in, whether it be the products versus crude? Is there a certain, displacement in anything you're looking at?
Well, there's displacement. There's going to be displacement and dislocation all over the place as a result of these Venezuelan sanctions. Obviously, on crude, refiners have to figure out how to make up for like 500,000 barrels a day of Venezuelan exports. That's a pretty big number, and they're going to have to source some heavy crude and probably increase demand for light crude. So my feeling on crude is that it looks as though the path may be irregularly higher here, but really what I think is going to happen, and it's already beginning to happen, Michael, is that the structure has almost has to tighten up. The front to backs, where the front rallies relative to the back, and you look at some of the, not only in the front, say March, April, May, June, but like June Dece, they're all beginning to make moves, and it makes a lot of sense that those the spread should definitely, I shouldn't say definitely, but more than likely will continue to tighten up as refiners try to figure it out. Gasoline, as I said, is, I guess, on a crack. If you look at a gasoline crack chart, it looks awful. I mean, gasoline has really gotten whacked relative to crude and relative to distillate. I can't say things are going to turn around on gasoline anytime soon, but maybe the crack is so oversold that we get a bounce. The other thing that could happen is if the margins are not that good, and now that heavier crude is more expensive, we could see runs begin to they're going to go down because of turnarounds coming, and we could, I don't know if we're going to see economic run cuts, but it's possible, and that should help the crack, gasoline relative to crude. So that's something to watch. And on diesel, that crack's been running pretty strong. I'm sort of neutral on the crack, and diesel too. You might see some the spreads too, if they follow crude, and they sometimes do. Those spreads too should tighten up along the curve. So I think there's a lot of opportunity on trading structure here, Michael.
So here's a question for you. All the news with Venezuela, how's that affecting crude oil short term and long term, you think?
Well, again, the Venezuelan, a lot of, they export to us about 500,000 barrels a day. They probably can, it's a heavy crude that's exported, so there aren't all that many refineries that can take that elsewhere. They're going to have to figure out, where they could sell it. China would be, China probably may be able to take some more, but the Venezuelans are going to have to discount that pretty deeply. And, and until they figure it out, and until there's new trading patterns, it means that their storage is going to fill up, and ultimately their production is going to decline further. Again, all that is, it's net constructive. There's no doubt about it, and one they're producing 1.1 million barrels a day right now. I saw one analyst saying it could go down to 600 a day. Net loss of 5. I don't think that's right, but I think we could see another 200 to 300 down. So you take another 300 down from Venezuela, Libya. This has gotten like just moving on to
Haven't even
OPEC,
heard the word
Michael.
Libya in a long time.
Yeah,
Got so
well,
many other things to
exactly.
talk
You
about.
haven't heard it, and it's incredible because their largest oil field is still closed. Because it's being occupied. So that's a loss of 300 a day out of Libya, plus this probable Venezuelan loss. OPEC production is going to go down, whether OPEC likes it or not, because the Saudis have said again. I don't know how often they have to say this before the market says, "Oh yeah, Saudi Arabian production is really down." They say their target is 10.33. Al-Fali said in December they were going to produce 10.2, and he had to say it again, for the next 6 months. So they're going to be below their targets. So the point is supplies are going to continue to decline way more than any potential loss in demand. The market, and I've said this before, the market is completely wrings its hands over potential for demand loss. You see it in the headlines every day. But the reality is that the most we're going to lose, let's say the economy really does slow down, but doesn't go into recession this year, the most we're going to lose is like 400 tops, and it's probably going to be less than that. We've already lost that from Libya, Saudi, and probably now more from Venezuela combined. So actually, the reality is, U.S. producers, we have to come through. We really need to grow our production. It's actually, laying it out. It's certainly more bullish than bearish.
Yeah, no, absolutely. So you're saying more bullish than bearish. So it seems like a lot of things are shaping up to be more bullish than bearish right now. We had that significant move in December where it took us down into the low 40s, but maybe we're seeing that's a bit of is more positioning and liquidation and liquidity potentially.
Oh, I think the move down to the low 40s, definitely. I mean, you had certainly the macro, the inventory, the equity markets where everything was good. Everything was extraordinarily weak. Um, I think there's some of that. There was a large long position that was liquidated in December, which added to it. And I think the market just got completely overwrought about where the demand numbers were coming in, or where they thought they were going to come in.
What else do you find
Um,
interesting, being that it's coming to an end of a great January for risk assets, equities up, crude up? What are you thinking about coming into February?
Again, I think you look at where crude is, and we may chop around here. It isn't. We just had a big inventory build, not this week, but as I mentioned, the total stocks have grown by 30 or 40 million barrels since just the middle of December. So we are going to start probably working through that inventory. So I kind of think we may chop around. I mean, obviously, you look at the chart, Michael. Uh, there's like one of the great classic John Murphy inverted head and shoulders of all times, and it looks like 55 is the neckline there. So I'm sure every trader is watching, is watching 55, and maybe we blow through there. The market takes a run, but I'm sort of thinking that I'm sort of thinking we chop around here first. But we'll see. I mean, today's a big day up. Of course, Monday was a big day down, and I guess if I was to believe the press, it was because Caterpillar earnings and Nvidia were poor. So the global growth is going to be poor this year, and oil demand is going to collapse.
Hmm. Well, it's definitely been a big start to the year in Jan, but we'll definitely keep an eye on everything and continue to speak. I appreciate you taking the time. Commodity Research Group's Andy Lebow. We'll talk to you later.
Okay, Michael.